Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Hello and welcome. Now, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. The key pattern here, unlike the American markets, continues to be the purple highlighted mid-March to mid-May shallowy bearish shift pitchfork. The market right now just under the purple middle time, which is currently at 192 3/4. This bearish shift pitchfork continues to be an excellent indicator of the market's overall bearishness, though we also seem to be in between the support from the March 2021 low at 191 3/4 down to the congestion at 187 1/4 and the resistance from the July 21 low at 187 1/4. And that's up to, I suppose, the declining mauve medium moving average, currently at 196 3/4. Looking below the September lows, the market has, as I said 9 weeks ago, and I quote, "We don't seem to have anything that significant support until the August 2020 low at 196 1/4 area." And that's the end of that quote. Whilst above the mauve medium moving average, you might have clear territory until the lows of late June and early July in the 204 area, as well as where the purple upper time sits right now, which is currently at 204 1/4. Minneapolis wheat. The market here seems to be held to the sway of 2, possibly 3 features. The first is the bright red May to July head and shoulders top neckline, which is currently at 513. This neckline has not acted as a cap, but more as an attractor, and had been pressuring prices lower. Now, adjacent to this and running shotgun had been the green short medium moving average, currently at 579, which had been a bearish pressure until last week, when it started to become a support. Part of me can't decide if this has been because the green short medium moving average or the bright red neckline had been leaning the market low, which one it was, but I guess we'll soon see, as they have now started to separate. Further below, we have the dark blue September 2019 today uptrend, currently at 567 even. This one had been realigned so many times, but it finally seems to have found its groove here. There is no real double bottom pattern here, as we have seen elsewhere, but that doesn't mean we will not be immune to the results of such patterns elsewhere. So just be aware. However, there is a larger pattern which I would draw your attention to. Once more, I spoke about this pattern 12 weeks ago and ever since, when I said, and I quote, "We are also possibly on the threshold of a really big pattern, a December 2024 to date possible cat's ears pattern. This is a bearish pattern, but the discussion for this, which I have postponed for a couple of weeks, may be coming up and real soon, as we're about to trigger the downside opportunities of such a pattern. It is a long-term pattern, but I urge you to keep remembering this idea, as if we travel and stabilize a little lower than where we are, I may feel obliged to deploy it along with its ramifications." End of quote. Now, I still stand by this, and I've watched the developments around the gapping action in September and late October and early November's moves once more towards the lows of September with great interest. We are still relatively close to triggering this pattern, and this is where 2 other factors may play a crucial role. The first is the bearish pressure of the declining mauve medium moving average, currently 587 1/2, which impacted the market this week. This doesn't have pedigree in pressing the market lower, but it's still there nevertheless, just sitting there. Second is a little higher, and this one does have pedigree. It is the purple July 23 to date downtrend, which is currently at 595 1/2. Now, this impacted the market back in late June and again in early July, and capped the market back then with a head and shoulders top, so watch out. I suspect that will be the one that will be key on any attempted moves higher. London UK feed wheat. Okay, so there had been on this daily chart until early July and running for around a year, one major significant pattern here, a pattern that we have not seen in the other grain markets, a pattern that I still have on my daily chart, and that's for a reason. The pattern is the bright red late May to early July 2024 bearish shift pitchfork. In early July, due to changeover, we had a very large gapping move higher, up and out of this pattern beyond the bright red upper time, which is currently at 159.35. Now please remember that level, and also the idea of the bright red upper times that will show up again shortly. Now added to this upper time back then, we had higher up the important, even today, the important 50% absolute Fibonacci line, which is at 180.5. And you had there, and even now still have, an area overhead that is a significant resistance, as it capped the market on its rise back in July with some added nearby help at the time from the purple July 23 to date downtrend, which is currently at 177.60. Since that peak, we've seen prices ease lower, moving it eventually below all the moving averages and penetrating, but not really, or consistently pushing below the bright red broken upper time, seemingly happy to sort of slide along the top side of the bright red upper time for quite a while. What is more important is, and this is key, is that we are establishing the market below the very, very important dark blue neckline extension, currently at 168.45. A neckline to a pair of very long-term patterns that I will shortly detail. I also drew some weeks ago a new late January to mid-July bearish Andrews pitchfork to hopefully show the new bearish angle of attack. This pattern was not a perfect fit, such that 5 weeks ago, excuse me, I said, and I quote, "I'm not fully sure about this pitchfork, and I may finesse this to a shallower bearish shift pitchfork with the same move at a later date," end of quote. Well, that is what I have done, and you can see it bright green on my daily chart with the market some midway between the bright green upper time above, currently at 177.35, and the bright green middle time below, currently at 154.75. As you can see, it's quite shallow and wide. This all leads me to my final points, the same points I've been discussing for months now, and some of them were something that I noted back in my annual commentary back in January this year on London Feed Week. To see these, it is best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern, akin to a double top, but formed after a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date very large head and shoulders top pattern. These two super long-term patterns both rely on one single feature, and that is their common neckline, which is highlighted in purple on my monthly chart and is currently 168.45, and that's the same as on the daily chart I just spoke about. Thus, a primary target X3 for the bearish cat's ears pattern will be down in the 127.5 zone, just below the bright red and big old 2005 to date uptrend, currently at 132.45. A secondary, harder to reach target X4 will be down in the 112.85 zone, around where the shallow dark blue lower trend line is. That's currently 114.25. And that's for the 2007-2022 ascending expanding wedge pattern. But head and shoulders top, we have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts, and that's the 1975 to date. Yes, a half-century old uptrend, currently at 66 even. I'm not even going to give you my secondary harder achieved target for this pattern. This is below 0. Please bear in mind that these are very long-term patterns stretching possibly over many years, but there are still targets below for these patterns above. Now, that all being said, July with changeover threw a major spanner in the works for such a long-term patterns. The reactionary immediate countering monthly key reversal up for July went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5 and just under the bright green 2023 to date upper bear channel line, which is currently at 178.65. The question is posed, and it is a longer term question, is whether this was just a reactionary single month move higher or the beginnings of something else. Once again, as in my previous commentaries, I will continue to stick to the reactionary single month move higher, but I'm prepared to start looking at the possibility of a new base of support, not only being built but also being exploited for a possible move higher. Now, there's one caveat to this basing higher idea. There's one I've already mentioned, and that's the bright green mid 23 to date big bear channel. It's currently 130.60 to 178.65. Even with such a big reactionary move back up, we are still sitting within this big bear channel, and it does have the advantage of already having at least the minimum 5 touches necessary to legitimize it. For all this discussion, we are still dealing here with some very long-term patterns, and you should please bear that in mind. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.